Welcome to Breaking News to Trading Moves. Today we're looking at a pretty high-profile agreement that just happened involving Pfizer and the White House. It's all about drug pricing mechanisms. And we're really just focusing on the headline news itself and how the market immediately started, sorting companies into winners and losers across pharma and healthcare.
That's right. The core of it is Pfizer agreeing to what's called most favored nation pricing principles, MFN for short. Basically, it involves cutting prices for certain drugs and Medicaid, and maybe more structurally, announcing support for this TrumpRx discount website.
A direct-to-consumer angle there.
Potentially, yes. It bypasses some of the usual channels.
Okay, and the deal itself there are trade-offs, right? It's not just price cuts. These reductions, they don't even start until 2026. And in return, Pfizer gets tariff relief. Plus, they've committed to this really large $70 billion investment in the U.S. R&D manufacturing.
Exactly. A huge commitment. And that's really the crux of the market reaction we're analyzing. Who benefits from this clarification, from the investment, and who faces new pressures because of it?
It's like the market drew lines in the sand almost instantly.
Pretty much. Investors started calculating exposure right away. Who gains predictability, who loses leverage.
Okay, let's start with the positive side then. The market sectors that got labeled as winners. Who's breathing easier after this?
Well, the first group, maybe surprisingly, is Diversified Big Pharma. The initial take seems to be that the earnings hit isn't catastrophic, mainly because the MFN pricing is specifically targeted.
Targeted how?
It applies to the Medicaid segment, and this is key, mainly for new drugs coming to market, not the existing blockbusters that are already generating billions.
Ah, I see. So the existing revenue streams are mostly protected.
Largely, yes. And for companies like Pfizer, this actually brings some clarity. It removes some of that regulatory fog, makes planning the pipeline a bit easier.
But still, agreeing to MFN pricing, linking U.S. prices to lower international ones. Shouldn't that worry the market? Why winners?
It's about the trade-off. They're essentially paying a price, yes, but they're buying regulatory certainty, maybe for much of the next decade. Plus, that $70 billion investment commitment, that helps shield them from perhaps harsher actions later. They get the tariff relief and this new potential sales channel with TrumpRx.
So for Pfizer, PFE, it's seen as a net positive for now.
That seems to be the read. Policy clarity is valuable. And we see a similar reaction for peers like Johnson & Johnson, J&J. They're viewed as pretty resilient, broad product range, not heavily reliant on Medicaid specifically. And Merck, MRK too, their big drugs tend to lean more towards Medicare and commercial markets, so the MFN rules on new launches, probably an acceptable cost for them given the broader regulatory stability of Mount Signal.
Okay, so it's a strategic move, buying stability. Got it. Let's move to the second winner category, Medicaid managed care. The insurers, how do they benefit? What's the mechanism?
This one's more direct. It's about cost savings. If this deal leads to lower net drug costs in Medicaid, well, that savings flows to the insurers running those state plans.
Okay.
Lower drug spending directly improves their medical loss ratios, MLRs.
Right, the MLR. Just quickly, for anyone not familiar, what does improving that ratio actually do for them?
It's pretty simple. MLR is the share of premium dollars they have to spend on actual medical care, including drugs. If drug costs go down, they spend less of that premium money on claims, which means their profit margins on those state contracts get better. Makes the plans more affordable for states, too, potentially.
Makes sense. So who are the main players here?
Companies with big Medicaid footprints, obviously. Centene, CNC, is the biggest Medicaid MCO, so they stand to benefit quite a bit. Molina Healthcare, MOH, is another one known for being really focused on the Medicaid market.
Okay. And the third winner category, this one's tied to that huge investment pledge. Drug manufacturing and lab suppliers. Yeah. The Capex Beneficiaries. $70 billion. That's a massive amount. Is the market seeing this as genuinely new spending?
It's being treated as a very strong demand signal, yeah. Stretching out over the next decade or so. Now, sure, some of that spending might have been in the pipeline anyway, but this commitment really locks it in, accelerates it, and directs it specifically to U.S. sites. That means more demand for everything needed to build and run those facilities, capacity, equipment, specialized services.
Right, that kind of capital expenditure should lift the boats of the companies that supply all that stuff.
Absolutely. The money flows down the chain. You think about companies like Thermo Fisher Scientific, TMO. They provide bioprocessing gear, instruments, consumables, essential for scaling up. Danaher, DHR, is another key name. Biotech tools, single-use systems for modern drug making. A commitment like $70 billion basically helps secure future sales for these types of suppliers.
Okay, so we have winners through clarity, through cost savings, and through direct investment.
Yeah.
Now, the flip side, this kind of deal usually creates pressure elsewhere. Let's pivot to the market sectors the street labeled as losers. Where's the pinch being felt?
Well, the group facing probably the most structural challenge is the pharmacy benefit managers, the PBMs. The threat hits them from a couple of angles, really challenges their basic model.
Explain that. PBMs usually sit in the middle, right?
Yeah.
Negotiating between drug makers and insurers, making money on rebates.
Exactly, and that's the problem. First, this federal TrumpRx's direct buy site. It's a direct challenge. It's an attempt to let some buyers bypass the PBMs altogether for certain drugs. Second, just the idea of MFN pricing itself, even if limited initially, it undermines their negotiating power. PBM economics rely heavily on those big rebates they negotiate off high list prices. If brand prices start lower because of MFN,
Then the pot of money available for rebates shrinks. Less to negotiate, less spread for the PBM.
that's the core pressure. Their whole value proposition as the intermediary gets questioned if prices are pushed down up front and there's an alternative way to buy.
So who's most exposed here?
Companies with big PBM arms, CVS Health, CVS through its Caremark unit, that's a major part of their business, and Cigna, CI, with its Express Scripts PBM. The market is basically pricing in the risk that they see lower volumes, less negotiating leverage, and tighter margins going forward.
Okay, that makes sense. Moving to the second group, feeling the pressure. High list price specialty biotech companies, especially those with drugs launching soon. Why them specifically?
This is about future revenue expectations. Remember, an MFN caps U.S. launch prices based on lower international prices. For a specialty biotech, particularly in areas like rare diseases, they often count on very high prices right at launch in the U.S. to recoup R&D and maximize returns.
Right, those first few years are critical for them.
Exactly. If the potential starting price in the U.S. is capped lower because of this MFN framework or even just the threat of it, it immediately puts downward pressure on how investors value their pipeline drugs. Their peak sales estimates get revised down.
So it changes the math on their most valuable upcoming products.
Forces a recalibration, yeah. Companies like Regeneron, REGN, they focus on those kinds of specialty biologics. They're looked at through this new lens now. Also Vertex Pharmaceuticals, VRTX. They specialize in rare disease therapies that often command premium prices globally. They face direct questions about future pricing strategy.
Okay, and the final category of losers, generics and companies with brand-adjacent legacy portfolios. This seems a bit counterintuitive. Lower brand prices hurting generics. How does that work?
It's about the competitive dynamic. Generics make the most inroads when there's a really big price gap between the branded drug and the generic version. That wide gap encourages switching, right? Payers push for it.
Sure.
But if the branded drug price in Medicaid comes down significantly, some analyses suggest maybe even 50% for some drugs under this deal, well, that price gap narrows.
So if the brand name drug gets cheaper, there's less financial reason for a patient or the insurer to insist on the generic substitute.
Precisely. Less incentive to switch means the generics face tougher competition. It can eat into their market share, potentially their margins, too. This puts pressure on companies like Viatris, VTRS. They have a big mix of generics and older legacy brands. Teva Pharmaceutical as well, TEVA. They're listed in the U.S., huge generics business. They're sensitive to that price gap narrowing.
So this one agreement really demonstrates how a single policy move, tied to a big investment, can immediately start to rearrange things. How capital flows, how pricing works across healthcare.
Yeah.
We've seen this trade-off, more price visibility, maybe caps, in exchange for guarantees on domestic manufacturing.
Yeah, it's quite the balancing act. You have the price mechanism aiming to address political pressure on costs, and then the $70 billion pledge addressing the industrial policy side, jobs, and domestic capacity. Maybe the thing for you, the listener, to consider is whether this becomes a template, linking price concessions to concrete domestic investment. Is that the new playbook for regulatory deals in the U.S.? That dynamic could really shape policy for a while.
That is definitely the question hanging over the industry now. Thanks for walking us through how the market is seeing these winners and losers emerge.
Happy to do it.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.